Welcome to the DC Bar's Brief Encounters podcast. I'm Michelle Heisner, a partner at Baker McKenzie and co-chair of the DC Bar's M&A Subcommittee, and I'm joined today by my friend David Haigh of Atlantic Global Risk. David actually co-founded Atlantic Global Risk, which is a specialist insurance broker that differentiates itself by focusing on transactional insurance products and expertise that helps give them more insight into how insurance solutions to transactional problems can be structured. We're here today to talk about the considerations in securing representations and warranty insurance, or colloquially referred to as RWI, in carve-out transactions. So what is a carve-out transaction? A carve-out transaction is the sale of one or more, but not all, of the lines of business of a company. So the key feature of a carve-out is that the seller continues to operate non-sold lines of business. And as a result, carve-outs can be amongst the most complex and costly M&A transactions undertaken. Assets and liabilities often need to be moved around within the seller to enable a package that can be sold. And there are often interdependence issues between the business being sold and the retained businesses of the seller group. Earlier this month, Dealogic reported that 9,155 carve-out transactions worth $2.3 trillion were announced globally last year, a 67% increase in value over 2020. And the challenging macroeconomic environment is probably a primary driver of this trend, motivating companies to scrutinize their operations and perhaps sell unloved assets, whether they're unprofitable or simply not part of a company's core business strategy, with the hopes that they'll flourish with a new owner. So given the prevalence in RWI in today's M&A market, we wanted to talk to David to understand the unique challenges to insurance coverage posed by carve-out transactions. So David, I wanted to just hop right in because I think that 30 minutes is just not enough time to tackle such a complex topic. So to start us off, I wanted to know how RWI insurers view a carve-out deal that's relatively straightforward. That is to say, the entity is fairly standalone. It requires a limited TSA, or what we refer to as transitional services arrangement, for a short period of time post-closing versus one that's more complex. So extensive pre-closing reorganizations, historic asset and entity sales, et cetera.
Hi, everybody, and thanks, Michelle. Yeah, I think it's interesting. I don't mean to put this to scare anybody. RWI is definitely available for carve-out transactions, no matter how complex or how simple. Clearly, with a more simple transaction structure, as you mentioned, with a limited TSA and an operationally independent target business, that's going to fall more broadly within many more insurers' appetite, and it's going to be much more simple to underwrite than one that's more complex because, of course, with a carve-out transaction, you mentioned it earlier, the package is not clearly defined. Certainly at the beginning, it's not clear what's in and what's out of the package, and you have to do a lot of work to figure out what is and isn't in the package and make sure that you structure the rep and warranty insurance policy accordingly to ensure that any buyer of the package is adequately protected. So I'd say if we're on the simple end of the spectrum, then it might not look too dissimilar to a traditional buyout, to a typical rep and warranty policy. But if it is not as operationally independent as, the more simpler end of the spectrum, if it is a more complex carve-out, then there's a lot more things to think about. Rep and warranty insurance is still definitely available, but there's a lot more to work through.
So then what are some of the most challenging aspects to securing a really fulsome RWI coverage over a carve-out transaction, assuming that we're not falling on that very simple, end of the carve-out spectrum?
Yeah, so let's talk more about the package. And I think, as you mentioned, carve-outs themselves are target businesses that are not operationally independent of the seller, and therefore, as of closing, they can't operate as a standalone enterprise on their own. And so there's this need for, as you mentioned, a transitional services agreement or a TSA. And what does that do? It ensures cooperation among buyer, seller, and company to ensure that the buyer can stand up the operations of the target company and that there's no interruptions, if you like, to its operations. So understanding how the transaction is structured, how operationally independent the target business is a key component of making sure that the buyer gets everything that it needs to continue the operations of the target company so that that transition can be seamless. And as a result, you bring in a lot of complexities there to the structure. We often see a pre-closing reorganization, as you mentioned, Michelle, moving assets out of the target company to retain with the seller. The big question there is, well, what becomes of those liabilities? Do they move with those assets contractually, or do they remain within the target company? And to the extent they remain within the target company, then you've got this situation where a rep and warranty insurer is potentially picking up liabilities associated with assets that aren't being acquired. And that brings in a degree of complexity. It means that you've got to figure out what's the insurer's position there. And I think if we're honest, most insurers don't want to be picking up liabilities associated with assets that aren't being acquired, and therefore painting that picture and getting out in front of that issue and dealing with it, whether through the contribution agreement or otherwise, is something that's really, really important to do. If you're moving assets in, do those liabilities come in with those assets? If they don't, then that's a great fact pattern for the insurers. And what actually is happening? Is this an entity deal, or is it an asset deal? Is it hybrid? Seen many complex carve-outs throughout the world where you get a whole mix of things. A lot of you get different assets, you get new entities, you get assets dropped into new entities, and you buy new entities. There's a whole plethora of different options that buyers and sellers might negotiate to best suit the seller's business and to best suit the buyer's business, and importantly, to ensure that this business stands alone after the fact. Now, this movement is important, but it creates risk, and it creates risk often in the form of tax. And so the tax consequences of a pre-closing reorganization are one of the really key focus areas of rep and warranty and insurers and underwriters. And as the market's evolved over the years, we've seen different positions. We've seen positions where insurers will insure steps that have been taken pre-signing. Why? Because they can be diligenced, because they can be verified that they've actually happened. But 9 times out of 10, they don't actually happen pre-signing because it takes involvement and negotiation from the buyer. So more often than not, it happens in that interim period. And there we've seen a range of different options from insurers. Some insurers offering to underwrite the pre-closing reorganization and the steps that take place pre-closing through conditional exclusions, through due diligence, through confirmation that steps have been executed in accordance with any steps plans. But we've seen others that have outright refused, and they've outright refused because, hey, these aren't pre-closing liabilities of a target company. These are liabilities that are created to organize the transaction perimeter so that the business can be acquired. And then what often happens if you're dealing with an issue over risk allocation, then you start to deal with the standalone tax insurance market and try to negotiate tax liability insurance policies. So I think in summary, one of the more complex issues on a carve-out relates to the reorganization. It relates to what's being bought and sold, and the tax consequences of the pre-closing reorganization are the most important. The insurance market is very capable of bearing that risk. It's just how. And so a lot of our time is spent when we're negotiating these insurance policies is dealing with likes of yourself, Michelle, and figuring out, hey, what is the commercial plan here and what's actually happening? So to name one, I would say, the pre-closing reorganization is one of the key risks that insurers face on carve-out transactions.
So if I'm a seller and I'm contemplating an auction involving the carve-out of a business, what can I do up front to ensure that RWI coverage will be available to my buyers?
So I'd say with any seller, and this goes for carve-out or not, the key is preparation. The key is thinking about what's going to need to be required of the process in order to get you the highest sale price, get the job done quickly, and get the job done without any residual risk on yourself. And in today's market, that's pretty achievable. I think if I'm a seller, I'd be thinking about lining up rep and warranty insurance on the sell side and presenting bidders with a package that says, hey, yes, we are planning to walk away from all of these different things without liability. However, insurance is available and it's available on these terms. So I think being proactive about pricing rep and warranty insurance, presenting that package to bidders is really important. Why these transactions often happen on an accelerated timeline, particularly where you're dealing with public companies. They're complex. I think it's easier to explain the complexities of a transaction to a single person, i.e. a single broking contact, rather than have multiple bidders run off around the rep and warranty market, trying to explain exactly what's going on, causing confusion by hearing multiple stories from multiple different people. So I think By being prepared, sellers can easily articulate what's going on. They can price the insurance and do essentially 50% of the work with one point of contact rather than have lots of bidders run off trying to tell their different version of events and end up in a situation where maybe one doesn't articulate it correctly and gets there first. So I think preparation is key. Preparation can come through, preparing a report, often called the seller to buyer flip. I think that's hugely valuable in a complex transaction. I think it's certainly valuable in a complex carve-out transaction. So getting ahead of issues and presenting bidders with insurance is definitely something that they can do. I think also being aware of what comes with a carve-out and thinking about some of the challenges that arise out of transaction structuring. A good example would be the insurance program. Rep and warranty insurers, when they're underwriting a buyer's acquisition of a target business and they're deciding whether or not to step into the shoes of the seller and take on liability associated with a breach of a rep or a warranty, they're thinking, okay, if the worst happens, what mitigants do I have? And one of the key mitigants from a prudent run company would be a robust underlying insurance program. Now, if that insurance program sits outside of the transaction perimeter, which it often does, what are you going to do there? You're going to have claims made insurance policies that terminate upon closing. You're going to need to structure a new program, or at least the buyer will need to structure a new program. And what about the losses occurring policies? Because they're still in existence and they just sit within entities that aren't being acquired and they protect the assets that are being acquired. So how do you deal with that? So, thinking about sensible drafting around, access to insurance covenants so that you can get access to pre-closing occurrence-based policies is just a little thing that, while it might appear more balanced than what you might ordinarily see in a bid draft of a purchase agreement, recognizing that that's the place that we're going to get to, I think is really, really important. So the key takeaway for me would be preparation, thinking about things that are different by virtue of the nature of the transaction, i.e. the underlying insurance program, and also considering being proactive with going out and seeking insurance terms, i.e. doing a seller to buyer flip, presenting bidders with a package of insurance terms to help deal with explaining the complexities in a compressed timeline.
So if I can press with just one follow-up here, like as a practical matter, if you're trying to do a seller to buyer flip on that insurance, do you as the seller then need to have a fairly well-developed, services schedule for your TSA and, reorganization step plan then that you're presenting? Like, how do you actually have enough meat on the bones when you're talking to the broker and the insurance providers?
Yeah, so I think, how do you have enough meat on the bones? What's the bare minimum that you can kind of get away with, if you like, for seeking terms from the rep and warranty insurance market? You definitely need a bid draft purchase agreement with a scope of reps and warranties that you're expecting to lead with. It doesn't have to be overly buyer friendly. It doesn't have to be too balanced. Most of the insurers in the market and brokers alike recognize that these purchase agreements go through multiple iterations and that the version that is used to secure terms isn't necessarily what is going to end up being insured. So I wouldn't get overly concerned about the reps matching what's actually finally going to be agreed. So a bid draft of a purchase agreement is useful. A SIM to explain what the business actually does, why it's being sold, why it's ought to be bought, what are the key highlights of the business. Some of the key risk factors are always in there, distribution of employees, distribution of operations around the world, et cetera, et cetera. Key financial indicators are in there too. One of the key things with carve-outs, which wildly varies, is financial statements. It's usually a prerequisite to get into insurance terms that the insurers are able to review financial statements. With a carve-out transaction, that could be capital F, capital I, financial information, and who knows what that might be. Varies from an assembled spreadsheet to audited financials, audited standalone financials. So the variation in financial information is really, really key. And whatever the client has there is useful, because that's a key feature of underwriting and something that you need to get out in front of. So those three documents are the absolute core basics. And then in addition to that, we always seek the data room access to go through the documents and see if there's anything else out there that is going to be useful in terms of getting rid of any misconceptions about the way that the target business operates, any of the risks that the buyer might be inheriting, or indeed just to focus on things that the insurance might consider to be important. So data room access, which you're probably going to have at this stage, A bid draft purchase agreement, a SIM, and some form of financial information is exactly what's needed to go out and secure terms on the sell side.
So we don't necessarily, as a seller in a carve-out, need to have the details locked down in terms of the reorg steps and TSA.
So to address your point on reorg, I think, again, by this time in most processes, there's usually a draft steps plan. It's a good idea to have that. It's a good idea to have an understanding of what's going to be done pre-signing, if anything, and the timing of the steps. The exact steps don't need to be locked down. And to be honest, at this stage, you're not in firm negotiations with a single bidder. So you would anticipate that there are likely going to be changes. I would say an idea of the corporate reorganization is important, maybe some draft proposed steps, but it doesn't have to be final form because, of course, a buyer is going to come in and have their views and what's going to work for them.
And if I can flip the question around, what should you do if you are a buyer involved in an auction and the seller really hasn't dotted their I's and crossed their T's in preparing for RWI, and yet RWI is expected by the seller as a condition of a bid?
Yeah, I think engaging a broker early, engaging a broker that's capable of understanding the nuances that go along with any transactional risk insurance product, but in particular, how to apply, say, rep and warranty insurance to a carve-out is really, really important. I think that they should get out to market early to understand the appetite around the business, or understand any potential restrictions on coverage so that they can take that back to the seller and negotiate. I think essentially when you're in a bidding process, you really want to use the rep and warranty insurance as a string to your bow. What do I mean by that? I mean, the more risk and the more red line that you can push onto an insurer, the less that you're pushing onto the seller. And by virtue of that, you're more likely to look more favorable than other bidders. So thinking about areas in which you can push the insurance market to bear risk that avoids red line on the purchase agreement that makes your bid look better is definitely a good strategy. And that comes with time. So yeah, thinking about insurance as not an afterthought, not something that comes right at the end, but comes at the time that you know you're going to commit meaningful resources to a bid, I think is a valuable exercise. And understanding, as I said, what those restrictions are going to be, what those restrictions are going to be as it relates to the pre-closing reorganization and the taxes arising therefrom, or maybe restrictions on financial statements and how you intend to adjust your purchase agreement for potential exclusions or modifications to reps and warranties that you otherwise might not see on a traditional buyout.
Are there particular representations that you see as being problematic when you're getting RWI coverage in carve-out transactions?
Yeah, so I think the ones that are of key focus, financial statements is always important. Why is it important? Well, as we've been mentioning throughout this podcast, the business doesn't operate independently. And so as a result of it not operating independently, you don't always have financial statements that are prepared for the individual business itself. Rather, the operations, the financial operations, the financial performance tends to be wrapped into the broader sellers group. And as a result, it's difficult to pull out, at least on plain reading, difficult to pull out the financial information of the target company itself. So if you are dealing with capital F, capital I financial information, and it's just an Excel spreadsheet that shows some form of financial performance, but isn't necessarily a balance sheet or an income statement, then of course the question then becomes, well, what do you rep to? The typical financial statements rep is prepared in accordance with GAAP and presents fairly in all material respects. The financial condition of the company. Why is that? It matches the audit opinion that is often given to audited financial statements. Well, is that rep right if we're dealing with some undefined financial statements that have been knocked together in a spreadsheet? The converse to that is you may have audited financials and you may be able to give a perfectly robust rep. There's often a caveat sometimes in purchase agreements, sometimes in policies about taking into account the fact that the company hasn't operated on a standalone basis, and therefore the reps and warranties given by seller caveated. They're caveated to say, hey, we recognize that this business hasn't operated on a standalone basis, and so there might be inaccuracies in things like allocation of costs and expenses because, hey, before you were dealing with this, as a much larger group, you had collective buying power, you were maybe buying and selling things internally. That might not necessarily reflect what life is going to look like on the other side when you're a standalone business. In particular, if you're going to be bought by a sponsor and be stood up from nothing. So hey, we as the insurer or we as the seller, depending on where that caveat is placed, are not going to be liable for differences in allocations of cost and expense that don't necessarily reflect the true running of the business. That's a good example of where the insurers are certainly focused. I think we've seen deals recently where public buyers have bought businesses and audited financials are the delivery of audited financials are a condition to closing. Seen insurers amenable to actually to cover reps related to audited financials when those financials are delivered, i.e. at some point within the interim period. I think that's a great position for clients to achieve. But as a result of that, most prudent underwriters say, okay, well, what about the differences between the financial information presented at signing and, of course, the things that are identified by virtue of the audit? There are two completely independent processes. They're completely different. There are inevitably going to be differences, and we shouldn't pick those up. So how do you deal with that? And I've seen people deal with that with creative purchase price adjustment mechanisms. I've seen buyers wear it. I've seen sellers indemnify. So dealing with those financial differences where it's not going to be picked up by insurance is important. So as you can see, financial statements is definitely, I would say, the rep of key focus. As we are dealing with we're trying to identify and put together that package, which is exactly what the buyer wants to purchase and needs to purchase. The sufficiency of assets rep is pretty key. So that's the rep that says essentially that the assets of the business that have been acquired are sufficient for the business to continue running after closing. Of course, there's interplay there with the TSA. There's interplay with other provisions in the purchase agreement, like a wrong pockets provision that ensures that the buyer and seller make each other whole as it relates to what ought to have been bought is actually bought. And if by chance something ended up where it shouldn't have done, well, let's make sure it gets to where it ought to be. So sufficiency of assets is definitely another key rep on a carve-out transaction. There's, of course, taxes. Taxes is key. Why is it key? Well, we've talked about the pre-closing reorganization and the fact that tax reps speak to the pre-closing tax period more broadly. So you could end up, by virtue of the pre-closing reorg, picking up tax liabilities from that, which are going to be a focus. Tax liabilities more generally, taking a step back in insurance terms to recover loss under an insurance policy, in particular for a third-party claim, the insurers have to consent to the settlement of that third-party claim for that settlement amount to be deemed loss under the insurance policy. That's a very common position. So with any third-party claim, the insurers have to be involved and they have to agree to whatever monetary amount you agree to settle any claim. So how does that work when it relates to tax? And how does that work when it relates to tax returns which are outside of the transaction perimeter? And in particular, even if the seller is willing to disclose tax returns, which they're often not, but even if they were, how do you deal with conduct? Because these consolidated tax groups, the audits are going to be outside of the transaction perimeter. It's going to involve selling entities. It's going to involve, involvement from the seller. And more importantly, it's going to involve the buyer being able to see what's under the hood of the seller, which they don't necessarily want. They want them to only see the target group. So how do you deal with taxes? More often than not, we've secured discounts for our clients because we don't feel that there's actually a huge amount of income tax coverage under rep and warranty insurance by virtue of the fact that the seller isn't willing to give up conduct and control. And in certain instances, and most instances, they're not willing to give up the consolidated returns anyway, just to facilitate diligence. So I would say for me, if I'm looking at a carve-out, 3 key reps: financial statements, sufficiency of assets, and finally, taxes.
That's fascinating. I think after this podcast, I might go do some research and try to find some of these financial statement indemnities and other precedents that sound very interesting that you're speaking about. So much in carve-out transactions is driven by tax. And the tax opportunities and the hazards, they can be very complex when you're dealing with the sale of a business that may be spread across many entities within the seller's group. And so for that reason, attorneys are often grappling with, a lengthy multi-step carve-out plan designed to optimize tax aspects for the buyer and or the seller. What sort of coverage can parties actually expect then under RWI for tax aspects of a carve-out transaction?
So if we separate the carve-out from the pre-closing taxes as a whole, I think from a carve-out perspective, i.e. looking at the taxes associated with the pre-closing reorganization, most insurers will exclude the tax consequences of that as a starting standard position. Now, that can be negotiated. Depending on the timing of the steps, you might be able to secure coverage under the rep and warranty. For pre-signing steps, generally that's likely to be available because you can subject the steps to due diligence. If they've been done pre-signing, the chances are it's been more done to benefit the seller than the buyer, which gives the buyer a better argument to securing coverage, but nonetheless, it also gives the insurers a defense. With rep and warranty insurance, you can only due diligence the things that have happened. You can't necessarily diligence what's to happen because there's nothing to guarantee that the steps will in fact happen. So anything that's going to go on post-signing, why is that important? Because inception of the rep and warranty policy usually happens at signing, alongside the signing of the purchase agreement, to give the buyer that protection, that contract certainty that you have when you agree to buy the business. Notwithstanding the fact you don't have a walk away right, or maybe you do, that it's an MAE, you've got this insurance policy there to protect you against anything that you discover. So the inception of the policy is on risk. At that point, you can only cover essentially everything that you've diligenced. Everything else is going to be subject to conditional exclusion. Once the steps have been executed, once diligence has actually occurred, maybe you can get a rep and warranty insurer comfortable with removing its conditional exclusion. The safest, generally speaking, would be to look to the tax insurance market to get those taxes covered, or of course have the seller indemnify you for the tax elements of the reorganization. So I would say that coverage is available. The insurance market is absolutely capable of bearing that risk. It's just in what guise, at what timing, and in what form, in order to balance the needs of the insurer relative to the client, the buyer. And there's usually timing is the key feature there.
Okay. And so another feature that often defines carve-out transactions from the legal perspective is that there are usually some asset transfers that are necessary in order to carve out the business for the sale. So how should we be thinking about RWI coverage for liabilities that are associated with staying with the seller, that is excluded liabilities, including any liabilities that may be associated with excluded assets, but that a buyer nonetheless finds claims being made against them for post-closing?
Yeah, so I think if the assets are outside of the target group, again, you definitely don't want an exclusion for excluded liabilities. And to your point, Michelle, there could be a world in which, by virtue of acquiring the target business, the buyer is tagged by virtue of successor liability with liabilities that are outside of its ownership or its control. I think, you always want to look at the position. Can the insurer diligence the liabilities? Can they wrap their heads around what they are? Is the buyer acquiring the assets associated with those liabilities, and are they not? And I think if the liabilities relate to assets that are not being acquired, then you generally have a much tougher time. If it's just an asset transaction more broadly, and the seller is agreeing to retain certain liabilities, but you are buying the assets, then you've got a much stronger argument to ensure the retained liabilities there. Usually the reps are broad enough to capture disclosure. Usually you're able to diligence the liabilities associated with assets, even if contractually you're not assuming them. And there you're much more likely to get coverage than excluded liabilities or excluded assets that never were inside the transaction perimeter and don't intend to be at all anyway. So this is a really important part of what we do, is when we get a purchase agreement, when we see a carve-out transaction, we speak with the clients and really paint an accurate picture for the insurers of what assets are in the target perimeter, what liabilities are inside the target perimeter, what liabilities are out that relate to assets that are being acquired, and what liabilities are out that relate to assets that are not being acquired. And by carefully scoping out what those liabilities look like, only then can you get an insurance policy that fully protects the buyer for the things that it ought to be protected for.
So in carve-outs, you typically have interdependencies between the business being sold and the operations that are left behind with the seller. And as a result, you see transitional service agreements where the seller provides services to the buyer to continue the operation of the business being sold. And so I'm just curious, based on some of the things you've said today, do you ever see that the length of the transitional services being provided by the seller has any impact on the scope of RWI that's provided? So shorter versus longer?
Not necessarily shorter versus longer, but what I have seen is insurers play with the provisions in the insurance policy and amend the duty to mitigate loss. So there's a typical provision in the rep and warranty policy, the duty to mitigate loss is put on the buyer. What I have seen is certain insurers change that duty to mitigate to require commercially reasonable efforts of the buyer to try to recover losses under a wrong pockets provision prior to bringing a claim under the rep and warranty insurance. So as it relates to TSAs, even if they are very long and very complex, the main restriction that I've seen is to say, hey, buyer, if you have alternative forms of protection under the TSA or under a wrong pockets provision as a result of a breach of a rep where you also have this other remedy, then using commercially reasonable efforts to pursue that other remedy first rather than bring a claim under the insurance, or at least before bringing a claim under the insurance, has been the key thing that I've seen insurers focus on. But generally speaking, the TSAs aren't of too much focus, at least today, for rep and warranty insurance underwriters.
Okay. And last question for you. Ultimately, do you have a sense of how often RWI coverage is being used in carve-out transactions as compared to, more vanilla stock and asset purchases?
Yeah, definitely as it relates, because of the volume of these transactions, there are fewer, although your stats before were amazing. And it's interesting to see certainly an increase in the number of carve-outs over time. And undoubtedly that has to do with a lot of buyers chasing fewer assets and fewer good target businesses. And so they're looking to other methodologies to get their hands on good businesses. Nonetheless, I would say that carve-outs form a small subsection of the transactional M&A market more broadly, and as a result are insured less. Because of their complexity, I think there's a narrower market that is going to get you to the desired position and desired outcome. Hopefully, as more sponsors and more strategics do more and more carve-outs as a way of finding value and finding better targets, we'll see more in the insurance industry, but they still remain not necessarily the exception to the rule, but they're still in the minority.
Well, thank you, David, so much for a really informative discussion. I've learned a lot today.
Thanks, Michelle.
Can't wait to talk to you again at another time.
I was. Thank you.
Thank you.